Hello, this is AJ McDonald with Devin Jones. Today we're going to talk to you about interest rate cycles and when the Fed either starts an increasing interest rate cycle and what happens economically, but more importantly, when the Fed starts cutting interest rates, which is where we currently are today in September of 2025. So Devin, the Fed cut interest rates 0.25%, which is pretty standard. What usually happens economically?
Economically, usually that is a spurn of growth, I guess, as far as the economy goes. That it's usually a good thing. Usually, going into that, the Fed is typically a little concerned about a slowing economy, so it's trying to kickstart it again and potentially seeing a new supply of jobs and spending, I guess, is the biggest thing. That they definitely want to kickstart some of that. So usually that's, like I say, it's a positive sign for the economy. They do say that if you're cutting rates and you're not in a recession for the stock market, which is what we do around here, that's usually a pretty good sign for the next couple of years in the market. So anyway, I'll leave that part at that. But usually in a cycle like we're currently headed into, usually it's going to last a bit and it's going to spurn some growth. So.
Well, exactly. There's a little more cash available. So folks that are maybe going out to buy a vehicle, those auto loans are going to be a little bit less. Credit card debt, a little bit less. Mortgage rates, which don't technically follow the Fed fund rate, which is what the Federal Reserve manages. It's typically the mortgage rates are going to be off the 10-year Treasury, but there's kind of a similarity and a correlation that those will come down a little bit also. So people get to spend a little bit less on borrowing money. And, that is exactly what you were talking about, kind of spurring growth, a little extra cash in the budget, and the Federal Reserve really hopes that you don't save it.
Right, yeah, they want you to spend it.
They want you to spend that money.
Yeah,
exactly.
And companies certainly will benefit from that as well. So, it's an interesting cycle that we're headed into here for a bit.
Well, it is. Federal Reserve, their two main jobs is to keep inflation under control, and then secondly, trying to maintain full employment. I like to say, well, not everybody wants a job, so those people don't count. It's right. Everybody who wants a job, trying to keep them fully employed. Full employment, it's usually a 2 or 3% unemployment rate. And so the other good news, bad news when we see an interest rate cut, as Devin mentioned, historically, stock markets usually rise. Generally, it's going to be about a 2-year cycle. So that's great news. The not so great news is when we see cheaper interest rates, lower interest rates, cheaper mortgages, and all the other loans that we talked about, causes inflation.
It does, and that's a balancing act that they're on right now. So kind of dancing around a tightrope or on that tightrope. So.
Yes, and every president wants lower interest rates, spurs growth, the probability of making things look good economically, likelihood of either themselves or their party to be reelected is much higher.
Right.
So I haven't met a president yet. I haven't met that many, just a couple, but they all want interest rates low. And our current administration, of course, has been very vocal about cutting interest rates.
Right.
Like 0%.
Like zero. Yeah. Be happy with 1 or less. Absolutely. From what I hear. So, but you're right. It is a balancing act, and you got to pick your poison. It really. And so at this point, they're a little more concerned, at least where we're sitting right now, about a slowing economy, and so they're going after that as opposed to worried about the inflation side of it. So.
And generally speaking, we've had a lot of Fed chairmen over the years. Usually they cut or raise at a scheduled meeting, not always, but usually they do. Generally they cut or raise by 0.25%. And so 2025 we would expect 2 more cuts, so for a total of 0.75%, which should get things moving. As you mentioned, with it's cheaper for businesses to operate, cheaper for people to operate, and borrow money. So, anything else to add?
I think that covered it.
Okay. If you have any questions about interest rates, mortgages, the stock market, give us a call. Thanks for watching.